Hi everyone, I'm back again. And today I decided to do this recording because somebody sent me a cold email. Alvian asked me a bunch of really good questions as to how we invest at the pre-seed stage. And I thought that these would be applicable to many people, whether you are a fellow investor or whether you are an entrepreneur, as to how we think about some of these things. And I think on that note, if you have any questions for us, feel free to shoot them over. It's always my 2 cents only, and so take it for whatever it's worth. Many other people may think differently, but I'm always happy to answer questions. Feel free to cold email me at elizabeth@hustlefund.vc. All right, so let's look at what the questions are in the first place. So here are his questions. And he says, I have some questions for you. I see that Hustle Fund is focused on pre-seed. And from what I know, at the pre-seed stage, VCs mostly invest based on the story and the people. And, if you don't have any revenue, which by definition is pre-seed, how do you know that this person is the right person to invest in? And this is a great question. The second question is, how do you value the company? What percentage of the company are you taking for your investment? And then the third question, which is related to pre-seed, but I think related to every stage, is do you believe in growth at all costs? And so let's dig into this a little bit. And I think these are excellent questions because, it's really, really challenging to know, like, how should you invest at pre-seed? Companies don't have anything, and you don't know these people and whatnot. And so let's kind of dig into my thought process. And once again, I'm going to pull up my handy dandy whiteboard here, and let's just see if we can map out some things here. All right, share content, whiteboard. Here we go. Here's our whiteboard. All right, so how do you know what to invest in at pre-seed? Oops, all right, pre-seed, I can't spell it. Pre-seed investing. It's very interesting because I think that at early stage in particular, there is this constant debate amongst investors as to, do you invest in team or do you invest in market or what do you invest in? And for me, there's sort of this concept that I will just call market pull. And I very much prefer that over team. Now I'm going to dig into this. So this is actually pretty counter to how a lot of investors invest. What that means is actually when I'm looking at decks, just as an early stage, somebody cold emails us and I tell them, hey, apply on our website, and I'm looking through the decks of all these different ideas. I actually don't look up the teams at all. And you could be wondering, well, this seems like a terrible idea. Like, why don't you look at the teams? And the reason is, from my experience, I'll talk about what I mean by market pull, but getting to product market fit is the name of the game. And what does that mean? Well, what that really means is you are solving a real problem that has strong unit economics. So let me give you an example of a problem. Like, I could really go for a beer right now. I wish there were this robot that would come into this room and just hand me a beer. And that's a problem that I have, but is that a problem that I'm willing to pay for, or someone else is willing to pay for, at the unit economics that make it work, like the cost of the robot or the cost of the service for the robot or whatever? And I think the answer is probably no, although somebody could cleverly think up a model and I might change my mind, but I think just off the top of my head, I think the answer is no. So even though it's a problem, it doesn't fit within the parameters of the unit economics that would make it work, right? It would just be way too expensive to deliver a beer right up into my mouth and just pour it in. So what I'm looking for here is I am looking for my gut feeling, no numbers, my gut feeling around whether this company can get to product market fit, whether the company is solving a real problem that can fit within the unit economics. So that is what I'm looking for. And that is solely based on the idea. That has nothing to do with team at this stage. Now, later, we may try to figure out whether it's the right team to go after this opportunity. But in the beginning, when we're looking at all these different ideas, I don't even look at team. Because if there is a phenomenal team that is going after something where I don't feel like there could be product market fit there, I don't want to be investing at that point. And now a counter to that, other investors may say, well, people change their ideas all the time or they pivot, and that's fine. I really actually do like it when people get learnings and then they change their ideas. But my hope is, since we are a pre-seed investment fund and that the company isn't that far along, that they will come back to us later and think of us when they pitch their new idea, their new iteration of the idea. And that has happened plenty of times before, where we initially said, no, we don't believe in this idea for ABC reasons. And of course, we could be wrong. But then later the founder comes back and says, actually, I ended up pivoting into this other thing where we have conviction. So for us, the idea is really, really important. All right, what else goes into an idea? Like besides, and again, we'll just call it like strong problem, that there's a real problem, and unit economics, like the solution falls within unit economics that make it work. Now, again, this is entirely based on gut feeling. This is not based on your numbers. This is not based on your tests. This is based on having seen a lot of customer acquisition plays over the years, having backed a lot of companies, having done my own experiments, and I still do to this day actually experiment with my own iterations of various products. I don't turn them into companies, but I want to really stay up to date with the market and understand how much does it cost to get a customer on Facebook? How much does it cost to get a customer in these other channels? How hard is it to get a partnership? Things like that will very much factor into whether it will work for your unit economics. So it's my gut feeling around that. Other things that will affect this: differentiation, competition. Now, and this is where actually people don't know whether they're differentiated, and they often don't know if they're in a competitive market. But I'll give you an example of, there have been several times in my experience as an investor where I've backed a company that, actually didn't have much or any competition at first. And then all of a sudden one day, some large company came along and just started pouring money into ads in all the channels. And it's amazing, actually. You can see the cost of the acquisition go up tremendously. 100x, 1000x, because these big companies don't care. They'll just pour lots of money in to drive up the acquisition costs. And so even if your product is slightly differentiated, even if your product is slightly not not head-to-head competition with anybody, if there are a lot of players in the general space trying to just acquire people like crazy, not even considering how much it costs to do so, it's going to be really tough for a startup that doesn't have very much capital. Even for a Series A startup that has more capital than where we're putting money in, it's still going to be really tough. And I've seen, just portfolio companies kind of struggle with that, because you can't use those acquisition channels at all if that happens. Even if your unit economics were profitable before, the instant that somebody else drives up your costs, like that's hard. So then you have to go and find other channels, and maybe there aren't other channels, and then you end up relying on just organic acquisition, which is basically word of mouth or whatever, like not being able to do anything and your hands are tied. And then that, tremendously affects things. So this is how I think about things, and hopefully this answers question number 1. So the answer is people and story. Don't look up the people. Story to the extent that it's important in explaining how this is a problem and how your solution is solving it. And then of course I just have to get gut conviction around that. I'm often wrong. So I may not have a clear understanding, even from my experience, about whether this actually is truly a problem that can fit within the unit economics. The second question that was here was, what percentage of a company will I take? Well, at pre-seed, actually, it's less about how much of your company you're selling, because I write such small checks, 25K, in many cases, that's either a percent or less, depending on the post-money valuation there. And, in that circumstance, it's not about equity ownership. But I think, put another way, a lot of VCs think too much about equity ownership at the earliest stages, when really the right way to think about things is multiples on your money. So a fantastic example of this is Uber. If you put, $5,000 into one of the earliest rounds at Uber, at say 5 mil cap, I believe was the first round, then you would have made approximately 25 million at the IPO. And that I'm sure for your 5K, you didn't have really any equity ownership, but it's really the multiple on that matters. So that's the answer to question number 2. And then I think question number 3 is, well, what about growth at all costs? And I think it really actually does come down to a lot of this. I said I would come back and talk about market pull in a second, but I think what market pull is all right, you basically have product market fit, and if you put $1 in, the market is so strong that you can get $1.01 out. And again, that's just a lot of luck as to who finds it and who doesn't, in my opinion. I've backed a number of phenomenal founders who have just never found it, but I do believe if they were running a different business, they would, be incredible. So it's not just about the founding team. It's about the luck in your ability to find something that has strong market pull. So let's talk about that for a moment. What is kind of baked into that answer? Well, there are a number of things that go into market pull. One thing that we just talked about, and I've talked about on other videos, is if you put $1 in and you get $1.01 out, how long does that take you? What is your payback period? If that can happen on spend, that's fantastic. So payback period of like T = 0. The other thing that is baked into this is if that can't happen, what does your retention look like? So if you have a subscription product, whether it's subscription commerce or SaaS, what is that payback period? Do you have enough people retained to get paid back within 2 or 3 months consistently for almost all of your users? In which case, that's also great. So this ties back in with the question of, well, what about growth at all costs? I think one of the challenges we've seen as an industry in venture capital is that a lot of VCs never pay attention to the unit economics. If you are putting $1 in and on a unit basis, you will always get 80 cents out, this is not a good business. And I think that a lot of people thought, well, if we can create some upsells or whatnot, then we can improve that. And I think in some cases you can, but there are also many cases, and I'm thinking about like food delivery, where you can't. What else are you going to sell in that same transaction of food being delivered? So it's really important to look at those unit economics, or at least get a gut feeling for the unit economics. And if once a company starts having some data, looking at the cohorts and figuring out, all right, are your customers being retained here? How, quote, tight are the numbers? And if it looks like you can generate this $1 in and $1 out on a pretty quick payback period for, almost all of your users, like 99% of your users or more, that would be absolutely phenomenal. And that's when I would say you should start to press the gas pedal. But if you don't have that, then I would look at improving your retention. Maybe it's a problem with your product, that there are lots of bugs. Maybe it's the service, people don't like it. Maybe it's a bad experience, whatever. But after you correct for all those things, and let's say that it's good, maybe you also have to step back and consider whether you are actually solving a problem that people are willing to pay for within the unit economics that would make it work. Going back to the beer robot example, it just may not be possible, and it may require actually scrapping that particular idea altogether or pivoting into something peripheral. So those are kind of my 2 cents on these 3 questions, and I hope this helps people. And certainly, we very much see entrepreneurship and starting business ideas as an iterative process and a continual game. So for that reason, if people pitch us an idea where we don't feel like we have conviction around the particular problem or the unit economics of that problem or something along those lines, we would very much encourage people to pitch us again, because I think often founders walk away thinking, gosh, like they hated me or they hated my team. That is not the case at all. Like in most cases, especially if we never talked with you, we probably didn't even look up your team. We probably don't even know anything about your team, and you could be phenomenal people. We just didn't have conviction around the idea, and that's okay. I think everyone should ideate many ideas before going all in. So if you haven't yet started your company, I would actually not get married to an idea right away, and I would just test lots of different ideas before deciding. All right, that's my 2 cents on pre-seed. Come back at me with other questions, and I'm happy to answer them.